much. I'm cognizant that this is a Saturday conference, and I think this is just before lunch. So I think there might be some distractions there anyway. But I have to thank my panelists who came all the way from India, and also my friend Sami over here, who was dealing with quite a lot of deals, but we dragged him out. So the point that the subject is obviously talking about which jurisdiction, but usually what happens is that whenever people are starting to talk about jurisdictions, they tend to just focus on perhaps the legal side, but also there is a question mark that comes up as to what have you been comfortable with. With my experience of looking at this particular decision for some time, we'll try and have a much richer discussion around this place. So first, let's have some introductions. We'll start from you, Avijit, if possible.
I am Avijit. I represent Gujarat International Business.
Hi, this is Pramod Gubi. I'm a founder of Marcellus Investment Managers. We manage largely public equities, predominantly Indian equities, but in the last 3 years, we've diversified into managing global equities, largely developed markets, US and European equities.
I am 𝐶𝐻. I'm one of the founding team members at Axis Asset Management, so a little over 15 years with Axis. And over the last few years, we've tried to spread our wings globally, and that's the reason why I'm here. We have a partnership with Schroders PLC of the UK, and so far they have distributed us, but now we want to be known for who we are.
Hi, I'm Samir Bendashish. I'm from the funds and regulatory team of the law firm 𝐶𝐚𝐧𝐿. I've been working in Luxembourg and now here in the region on fund structuring, advising most of the global asset managers in their setups of funds, how to get licensed and where to set up for an effective capital raising.
Thank you. Brief background to myself. I'm an ex-regulator, advise various regulators. I run my own family office out of Abu Dhabi. I have investments in quite a lot of Indian funds, own several, bits of other asset management companies around the world. So, that said, I'm going to again go a bit deeper into why this discussion about jurisdictions should be a bit more sophisticated than, as I said, the basic legal discussions. If you look at the history of what, or the immediate history of what we're talking about, the vast majority of outbound discussions about which jurisdiction to look at the inbound market was fairly simple. You were going to Cayman if you were talking about American investors. Quite a lot of them were set up in Mauritius. Singapore was also pretty common, and that was all because obviously with the treaties and what the clients or the local regulations were requested, then UCITS started to come up. But now, at this moment, I think there are some substantial differences in how Indian asset managers are going to be starting to move. First is that one of the things that people have to recognize is that the geopolitical situation is going to be in utmost turmoil, at least for the next 4 years, and if not, at least for another 12 years. This is the kind of a situation that you're looking at. The economic barriers are starting to come up. And this is not just because of the geopolitical barriers that are coming up, but because of the tariffs, the discussions, all the initial signs that are being shown means barriers are going to come up. That will mean that the behavior of the allocators is going to be different. If you're starting to look at the top level, where you're talking about the sovereign wealth funds, and you're especially over here, and they do not get out of bed for anything less than $200, $300 million. We were just talking about it with Avijit, and some of the biggest large single ticket sizes that have been written out of Abu Dhabi, they were based after discussions of about 3 to 4 years. So whenever you are talking about having a presence, you need to realize that the pooling vehicle or the jurisdiction that you're talking about is no longer enough just to set up something that will be enough for you to just pool the vehicles. the jurisdiction also gives a signal to your major allocators or the people that you do need to be speaking about in the next 3 to 4 years that you are invested in them. We just ran a very large capital raise event in Riyadh last week, and there were $4 trillion sitting in the room. Riyadh has traditionally not invested in India. I was personally I took it very personally, and I've committed to triple the amount of investment FPI into India from there. But the blunt thing that they said was, if you're not here, why should I invest? If you start moving down into other classes of allocators, what you have to remember is that the emerging market where India belongs is just a very tiny sliver. People are starting to move back into what I would call as risk-free or less risk jurisdictions to invest. Finally, the amount of free capital or cash is going to be increasing. So you actually have to be in a place where you can keep on talking to people to make sure you can convince them to invest in your fund. So just thinking about it from a pooling side and saying this is what we have been doing, and it's because of low cost, I do not believe that particular strategy is going to work. You need to rethink that over the next 3 to 4 years, when you are going to decide where to set up your vehicle, you need to think about your allocators, you need to think about what the changes are going to happen, what the local allocators are thinking about, whether or not you're going to have a local talent which is going to go and speak to the allocators, so on and so forth. So that context given, I'm going to ask my friend over here, Sami, to give you, well, the basics of what the legal aspects are of the most common jurisdictions that Indian managers have used. And I'm also going to ask him to put his crystal hat on. I know I'm mixing metaphors, but there's a reason behind it, is to think about over the next 1, 2, 3 years, which jurisdictions might actually be more appropriate when it comes to Indian managers. One last point that I want to make is, Sami works for 𝐶𝐚𝐺. We, me personally and 𝐶𝐚𝐺 have been actually seeing one of the vast changes in how hedge funds have moved. A giant number of hedge funds have actually moved out of London into Dubai. And this kind of secular trend is something that is also going to happen with lots of other strategies as well. Sami represents a firm which has got, I don't know, 80, 90%. He's not going to comment, I can. 𝐶𝐚𝐺 have got 80, 90% of the market to help people move jurisdictions, and they are absolutely brilliant. So what I tried to do was to actually ask him to give that additional color rather than this jurisdiction does this or this jurisdiction does that. Sami?
Thank you, Doctor. And I totally agree with what you said in terms of allocations. I get often asked that simple question: what is the best jurisdiction for my fund? And I always give the lawyer's favorite response: it depends. It depends on especially where your investors are and who your investors are. There is no jurisdiction that is one size fits all and where you can easily set up and easily raise capital. You have to be close to your investors, you have to know what they want, you have to know where they want you to be. And that triggers questions around not only where is the fund, but where are also the teams that will be distributing your fund. Historically, for India, as most of you know, of course, one main jurisdiction which was ahead was Mauritius for tax reasons. In the recent years, we've seen Singapore taking a bit more the lead against Mauritius. We've seen also some investments from other jurisdictions, especially from Cayman, from the EU, whether they are from Netherlands or Luxembourg, thanks to also double tax treaties. Now, also with the gift city, we tend to see a new shift. Also, thanks to or because of some regulatory changes around the rules on marketing, we tend to see quite some shift on those traditional jurisdictions. For a large part of the main asset managers globally, they would have that classic parallel fund structure with the Cayman, with the Luxembourg one for European investors, with the Delaware, and in some cases, co-investment vehicles or vehicles in Mauritius. I will talk jurisdiction by jurisdiction for the investors. If your investors are in Europe, or if you want to target the European market for allocations, you have to have your fund in Europe. Plain and simple, because you will benefit from the marketing passport there. Whether it's UCITS or AIFMD, it has to be Luxembourg, Ireland, Netherlands. If your investors are in this region, or if you want to be close to your investors, and what Dr. just said is a clear example, the large institutional investors will want you to set up here, either in ADGM for the Abu Dhabi sovereigns, either in Saudi for investors, and we tend to see quite some fund managers setting up here, building the teams here, getting close to their investors, and then setting up their funds. As a first step, they can use a third-party ManCo, third-party fund managers to launch the funds for them, but they need to be here. A fund without an effective capital raising team will stay empty. It will just be a cost. Then next to that, you will have always the Cayman funds that will always, who knows, maybe in 5 years things will change, but still we see them as always attractive, and large professional investors are used to them and they're fine with them. But more and more they try to switch from Cayman to funds closer to them. Then 𝐺𝐸𝐶ity, and we'll hand over. 𝐺𝐸𝐶ity, if I were to guess what will be the classic fund structure for investments in India in the next few years or in 5 years, I would clearly imagine a master fund in 𝐺𝐸𝐶ity with feeders, one in the UAE, no matter whether it's financial free zone or onshore, or Saudi, maybe using the GC marketing passport, one in Europe for European investor, one in Cayman, and then it's up to the teams, to your teams, to use those jurisdictions and to raise capital. Of course, you wouldn't set up those funds before being sure that some investors are interested by your product, but that's what I would see. Multiple feeders and then one aggregator that will be in 𝐺𝐸𝐶ity.
Great. So that's what you heard. Now, I'd just like to add few things to it. As I said, whenever you're talking about jurisdictions or capital raise, well, we'll talk more about the jurisdiction. You've got to have one eye on the cat and one eye on the fish. If you look at we just talked about Europe, and I know you're going to speak about Europe as well, because you've got a fairly large presence over there. There is a huge head of steam building up in the European Union to actually further liberalize their capital markets. Number one. Number two is that the European yields on the domestic investments is dropping. There is a problem. Consequently, suddenly the attractiveness of Europe as a jurisdiction, and please feel to grab Sammy before he leaves, he'll be able to tell you more about it, and that man sitting in the end, who's managed to raise quite a lot of hundreds of millions in there, that has suddenly become more attractive. So these are the kind of things that I'm going to now ask each of the panel members to give a bit of their background as to what jurisdictions they have traditionally used, what were the reasons why they used it, and given the changed and rather volatile circumstances that are going to come up, what are they thinking? What advice would they give the people over here over the next 1, 2, 3 years? These are the things that you need to think about. So, Siva, shall we start with you, please?
Thank you. That's a lot to unpack. And I want to just pick up on what already Sammy talked about and what you already talked about. I think the asset allocator, the person making that allocation decision is supreme. So you have to be there. You have to be there where that decision is being made. So that's a given, right? And the fund structure that you create has to suit the client, is not to suit the manager. The fund structures are cheap, but the client access is hard. So I think that's one part of the story. We also need to be very mindful of the complexities which are created by interlocking regulations. So you mentioned, for example, being present in Europe through a UCITS vehicle. Now, UCITS cannot feed into a third-party, unregulated fund. For example, if I launch an India mutual fund or a 𝐺𝐸𝐶ity fund, UCITS cannot feed into that because that is seen as an unregulated vehicle. So these complexities also need to be kept in mind when you start thinking of multi-level or feeder master kind of structures, etc. How we think we are approaching. So in this context, given that we want to be closer to the customer, but we recognize the complexities, is through multiple ways. One is, like I said, we already have a partner with Schroders, so they have some UCITS funds, so that makes life easy. We advise or manage those funds which invest directly into Indian securities, that is available for many parts of the world. But I think increasingly GIFT City is becoming more important for certain types of access, for institutional investors who will want to invest in India. It's not about going to retail or HNIs, it's about institutional clients initially, maybe ultra HNIs, family offices to start with, and especially the Indian diaspora who may be familiar with India. It's a new jurisdiction, it's untested. It's going to be always hard to sell. It's going to be, DIFC took forever to get really going to size, and once it did, it really took off. There's a J curve, right? So you have to ride it out. So I think we need to recognize the fact that it's a long slog, but we need to be there. The big advantage that GIFT City gives you compared to many other jurisdictions is there is no DTAA. The problem with India is that you always worried what the taxman will do on your income from several years past, right? Because there is no DTAA. The tax between GIFT City and India is governed by tax law, not by an agreement between authorities. And that gives a lot more certainty about the structure, right? But of course, it's a new jurisdiction. There's a lot that needs to be done to give confidence to global investors that it works. And of course, GIFT works fantastically well for outbound investors because, well, Indian investors are already subject to Indian tax and Indian jurisdiction, so this GIFT is an extension of that. So I think we need to look at these vehicles from that perspective, that what is suitable for the end investor and be present with different vehicles, whether that's UCITS, whether that's GIFT, Cayman, etc. It's perfectly fine. I want to make an extra point here. The first reason to make an investment decision is the economic attractiveness of that investment decision. The jurisdiction decision takes a backseat, meaning if you want to make that decision to invest in a particular asset class or a country, you will find a way to invest, or you'll search for it. You may not find it, but you'll rightly search for a way to invest. But if there's no rationale to buy, why would you buy? So I think we should be careful not putting the cart before the horse, right? We have to see what is the rationale to buy. Just before this discussion, while we were sitting there, I was just mentioning that when you go back in time, or even today, most India investments are part of an Asia fund or a global emerging market fund. Nobody is making or I should say, very few investors are making an India allocation. People make US allocations. Even Europe, people are not making single country. They're making Europe allocations, or they're putting it as part of a global diversified. If you look at Asia, people prefer to buy an Asia fund or an EM fund. If you buy an Asia fund, they want emerging markets specifically, they buy Asia ex-Japan. China has 30-40% of that, so they may say, okay, I want an Asia ex-Japan ex-China. That's about where we have got to. Japan and China get separate allocations, the rest of Asia is lumped into one, that includes India. The only story is that Asia ex-Japan ex-China, India is now 30-40% of that. So if you have already decided I want to be in emerging Asia, you might as well take an India allocation. So I think the economic rationale takes precedence. And the moment global allocators figure out that we need an India view, just because India has become too big in my benchmark index and therefore requires a separate view, that's when they will start searching for it. And that by which time, which may be in a couple of years down the road, you better have your investment vehicles right. Because I think that time is coming close where people are going to have to make an India investment decision. And they cannot just take India through a global diversified or a emerging market fund. And I think we will have to have our jurisdictions and fund structures in place. So GIFT is one of many such vehicles that we will do. I think it makes a lot of sense because of the tax certainty, but it's an uphill battle to get people comfortable with yet another new jurisdiction. And I think that's where we are right now.
Pramod, your views, please.
Yeah, no, I think 𝐶𝐵 made a brilliant point. At the end of the day, the primary decision has to be the rationale for why you're investing. The jurisdiction is more incidental. I think where there is a need, the options or solutions will come. So just to give a little bit of background about the jurisdictions that we operate in, For Indian residents, of course, we do domestic PMS in AIF. For foreign institutions, Abhijit, in fact, helped set ourselves up in Mauritius in a fund structure. But for most NRIs with an Indian PAN card, you can do a PMS straight away. But coming back to Sivakumar's point, I think given the conversations here, we are all here to discuss potential opportunities in investing in India. But over the coffee break, several of you kept asking, how long will this correction last? How much more pain is there? Should I get out of small cap? Should I start buying into this rally? I think these are absolutely valid questions. I know there is a big debate on Indian social media. Certain experts are saying you should sell out. Certain experts are saying you should continue to buy. We are somewhere in the middle. We reckon all of us need a framework, and the framework is about asset allocation. If you are well diversified across asset classes, particularly asset classes which have very low correlation, and you're disciplined about rebalancing, most of these questions don't arise at all. Simply put, for example, you would have made a lot of money in India in the last 3-4 years, right? So therefore, your allocation to Indian equities as part of your overall asset allocation would have gone up significantly. So ideal thing to do somewhere a year ago, you can't time these things to perfection, but if you're disciplined about rebalancing those, you would have brought down your Indian allocation anyways. And similarly, within Indian equities, you have large caps and small caps, and small caps have massively outperformed Indian large caps over the last 3 years, right? Now, if you got greedy and continue to pile into small caps, which is what the Indian retail investor seems to be doing, you will be asking these questions, should I live with this pain or not? But if you were disciplined about rebalancing and asset allocation, you would have started to take profits in small caps a year and a half ago. And perhaps you'll be better prepared now because this year, you'll get a great opportunity to buy into Indian equities in general. I'm not saying that I have a crystal ball to say that things will get worse or not, but that's the beauty of asset allocation if you're diversified. Now, on the same count, the reason why we are present in GIFT City is we find that Indians are massively over-allocated to Indian equities. I mean, this is not new, right? World over, investors have a massive home country bias. Even in America, where there are massive options in terms of internationalizing, 80% of their allocation tends to be in US securities, barely 20% in international securities. In India, almost 100% is in Indian equities, right? We are all bullish on Indian economic prospects. I think Vikas made a great presentation this morning. Over the next 10, 20, 30 years, the Indian economic growth machine will continue. Indian markets will give phenomenal returns. But even after that, it doesn't make sense to put all your eggs in the Indian basket. US and India are the two best performing markets in the world on a 10-year, 20-year, 30-year basis. In fact, in dollar terms, US is slightly ahead of India. And here's the best part. These two best performing markets have a very low correlation, right? They're correlated by about 0.3. As we can see, as we speak now, India is going through whatever it's going through in terms of the markets correcting, but the US is holding up like how? So the best benefits of diversification accrue when you diversify across uncorrelated assets, and we are blessed to have the two best performing markets from a long-term perspective having this low correlation. Other than very brief periods when there is global turmoil, say GFC in 2008 or COVID, you will see that the Indian and American markets have moved in opposite directions. And that makes it a great opportunity to rebalance. When US is soaring, take profits of US, buy into the Indian correction, because at the end of the day, corrections are the order of the day. You cannot wish it away. You shouldn't demonstrate any bravado by saying, I'm a mature long-term investor, I can live through these corrections. Even better is, can you take advantage of these corrections? To be able to take advantage of these corrections and buy into that, you need an asset class which is not correcting at the same time, so that works as dry powder for you to buy into it. This was the basic premise on which we started our global portfolio. So we started Marcellus about 7 years ago, primarily as managers investing into Indian equities. And as we started interacting with high net worth individuals and investors in India, we realized the need to diversify geographically. And we found that US makes a significant value addition in most Indians' portfolios. We started it about 3 years ago. We started it as a PMS out of GIFT City. And recently we've launched a master fund out of Cayman, because a lot of Indian investors said the GIFT City tax regulations are, although it's much better than what it used to be. Remember, for Indian residents, international equity taxation was quite penal. About a year and a half ago, they've been made equal. At least long-term capital gains tax for international equities is the same as domestic equities at 12.5%. But if you invest in a global fund out of GIFT City or global PMS out of GIFT City, as an NRI, it's completely tax-free. Because the Indian tax law says either the asset or the investor needs to be a tax resident. If you are an NRI based in, say, Dubai, investing into a GIFT City PMS, you're neither an Indian tax resident nor the global fund's assets are Indian residents. To that extent, it becomes a very, very attractive proposition for you to diversify away from Indian equities and yet achieve a significantly attractive tax structure. For Indian residents, we've launched an AIF, which feeds into our Cayman Master Fund, which also allows the GIFT City feeder has a 2-year lock-in. So to that extent, you eliminate all short-term capital gains taxes. So your taxation is generally long-term. But to the benefit of this audience, I presume all of you are non-resident, so you shouldn't be worried about Indian taxes. But just reiterating Shivakumar's point, I think the benefit or the reason for investing into a certain jurisdiction has to be based on the economic need. The jurisdiction is just a way of fulfilling that need. We've tried to do that using GIFT City and Cayman and Mauritius. Each have their own advantages and disadvantages, but that should be a discussion after you've established the need to invest in that particular asset class.
Thank you. Now, Abhijit, you have obviously representing Kotak, who's got a much wider footprint. Would love to hear your thoughts on various jurisdictions and your crystal ball lookouts in the front.
So I would like to say that we started our journey back in 1994, and it started from Mauritius. So imagine you are selling India from a jurisdiction which is Mauritius to the global investors. Today we are talking about India allocation and a separate jurisdiction, but that time when you go to investors saying that we want to sell in India from where Mauritius, explaining that would have been much tougher. However, we have come to a long way. Today we are present under the local regulation across all major jurisdictions from New York, London, Singapore, Dubai, and Abu Dhabi, servicing clients across the globe. As we speak, we manage close to $6.2 billion of India-dedicated asset for the global investor. Of course, when we evaluate any jurisdiction, as Sami, Shivakumar, and Pramod mentioned, the primary emphasis which is put is the convenience for the investor and whether their need is aligned to the particular fund structure which is going through. Of course, while evaluating the jurisdiction, we evaluate the regulatory infrastructure, operational efficiency, cost effectiveness, and the investor protection. But we put equal importance what is the fund promotion rules in the investor country. Along with that, the first hurdle was to, in fact, the main hurdle is to promote this fund through an appropriate distribution which is regulated in the investor home country. UCITS has been the most acceptable jurisdiction for the banks, insurance platform, and the many fund platforms. It provides some convenience to the investor to directly invest into the UCITS fund. Having said that, our journey for launching the UCITS fund was not easy. We launched our first fund in the UCITS platform back in 2010. And it took quite a long year to cross the first 100 marks. Today, we manage close to $3.9 billion of asset in the Kotak Midcap Fund, which is one of the largest India-dedicated fund from the offshore investor. It happened because it provides convenience for the investor through his banks and the insurance platform, and we had to put a lot of effort to meeting all these investors and the fund platform across the globe, stating that this fund to be approved in their fund platform. Similarly, we have another structure for the US client. As you know, US has been a very, very difficult jurisdiction. In US, we have launched the US 40 Act Fund back in 2010, 12, and currently we manage close to $350 million of US retail client asset under that platform, which is focused on the India investment. And it happened because it's also provided the convenience of access of this particular fund across the US investor through his banks and the broker-dealer. Finally, we come to the jurisdiction which we all started is the Mauritius. From Mauritius, we run various strategies for the accredited investors. Of course, Mauritius does not provide currently any tax efficiency if you are investing directly from the Mauritius to the Indian capital market. However, what we believe that Mauritius still provides the operating efficiency and the cost effectiveness. Their recent variable capital company regime provides one of the best investor protection as far as the accredited investor is concerned. A fund manager can launch a sophisticated strategy in a very cost-effective and the convenient manner from the Mauritius under the VCC regime currently. On that note, I must say, based on the current double taxation agreement between India and Mauritius, the Mauritian fund, which is investing in the India domicile mutual fund, is exempt from the capital gain tax. Having said that, the similar benefit is available to funds from the UAE, Singapore, and GIFC. Of course, GIFC is coming up with the many innovative initiatives. It is only time will tell how Mauritius can keep themselves relevant in the context of the India investments.
Great. Go ahead, Shiva.
Just a 1 minute follow-up point on things like innovation. I think this is a little important also in the context of this market volatility and all that. When you have some kind of market upheavals, maybe because of geopolitics, maybe because of market movements, people also want new products or something which takes care of the new realities. And you, let's say, okay, there's demand for maybe small cap, maybe, or demand for private equity or something else that you know, the investor demand keeps changing. One of the things about jurisdictions also, which jurisdictions allow the maximum flexibility to offer products quickly like for example, UCITS. You launch a new fund, it takes months, maybe years. Looking very...
I'm going to give an example. One of my businesses is run out of Israel. And you know Israel is a hotbed of PE firms and venture capital and things like that. And I'm sure Sami would be nodding. There are no regulations. I get a call on Thursday saying, I'm launching a new fund on Sunday. 3 days, funds are set up. Now, obviously, that is a completely unregulated market. But I think you should explore that point a bit further because you can't really spend 12, 18 months setting up a fund anymore.
Yeah, I think that's another very important thing when it comes to selection of a jurisdiction. You know, at the end of the day, you need places where, yes, you want investor protection, you also want good regulation. But at the same time, if that regulation stifles innovation, completely kills that jurisdiction.
Sami?
Absolutely. On the UCITS side, it is true that it takes a lot of time because it's open to retail and the regulators want to make sure that your fund, because of the need of protection of retail investors, your fund is adequately managed. So yes, it will take at least 6 months, sometimes more. On alternative sides, it can be much quicker. One way to reduce the time to market, to reduce your time to launch your new fund, is, I believe, the standardization of documents to some extent, agreeing with a regulator on a standard set of documents for your full suite of funds and incoming funds, partnering with a local fund platform that has already a platform in place that has already standardized documents. If you have that standardization, when you face the regulator, you can simply show them the limited changes against the precedent, the fact that it's all in line with the regulations, and you will have your approval in a much quicker time because let's be frank, any day that that the fund spends at the regulator is a day where it is not capital raising, where it is not investing, and where you're not gaining what you should have. So I believe one key is that standardization and streamlining the process, no matter the jurisdiction. Yeah.
Great.
Yeah, I'll just share my experience on GIFT City in terms of timing. In our case, from application to launch, it was 6 weeks flat. I think the GIFT City regulator is going out of the way to encourage it. It is clearly the Prime Minister's vision. It was set up to say that, you know, if Indian managers are managing money out of Singapore or Dubai or London, why not encourage Indian managers to be based out of India itself and run that money? So to that extent, red tapeism is gone. It's extremely attractive, particularly given the amount of investing talent we have in India. Today, you could be a budding fund manager. You don't have to go out of India to manage a global fund. And remember, investing is a fungible skill. If I'm good at investing, I can manage Indian markets, global markets, so I can sit out of GIFT City in your very own India, launch funds in 6 weeks flat, and manage global money.
Abhijit, you had some points.
My point is on the GIFT City innovation. I was surprised to see the regulation on the ETF in the GIFT City. So if you set up an ETF, so typically when you set up a fund across all the jurisdiction, the fund generally goes through a cycle of approving the fund for the multiple, the investment committee and all. But for the same allocators, if you give them an ETF, which is a security, so they can buy it without even going to the fund investment committee. So tomorrow, if they want to just quickly take an India allocation, if they take an ETF, it becomes a security for their portfolio. It doesn't have to necessarily go through the fund approval committee. I was very happy to see that GIFT City is coming up with a lot of initiative for the ETF, where Indian managers can set up ETF, and the market makers, and the cost is very, very effective. So operational efficiency, the cost effectiveness, I think GIFT City is coming up with really, really innovative solutions.
So look, I completely agree. I'm a big GIFT City fanboy. I've got 6 firms over there, and one of the things that is missing over there is lack of allocators who go there. I was quite surprised to see when you walk around in Pragya Accelerator, it's dark, it's like Bhoot Bangla. But hopefully we'll be doing some more and hosting an actual allocator event in GIFT City in the next few months. But I think we have run out of time. I'd just like to summarize. You heard, the first thing is obviously you need to have a good product. The second thing is you need to think about what kind of investors you want to go for. If you wanted to go for very big boys, then obviously, and who've got money, then Cayman, Saudi, Abu Dhabi are the place. If you're going in for the mid-sector, then Dubai, Singapore, and of course, if you're talking about retail, then you obviously need to target the US and Europe. The only thing that I'm going to say is that please don't just choose the jurisdiction based upon legals or what you have done before. Have a think about what your fund and what your next fund is going to choose. Remember, there is quite a lot of historical baggage that you carry based upon which jurisdiction you have chosen. So, thank you very much to my panelists to take this time and give their views. And I'd like to pass it back.